See, today's topic is lease versus buy. Now, what is lease versus buy? See, you can purchase a property. You can either purchase a property or lease a property. Okay. Now, why you should be, you know, purchasing a property like or leasing a property? That means why there is a need to discuss this versus this. That is the big question. First and foremost, when there is a comparison happening, it is definitely uh, to check which is a more beneficiary option. Okay, it is to check which is a more beneficiary option, whether buying is more beneficiary to you or leasing is beneficiary to you. Okay, how come that can be checked here? As we are doing investment decisions topic, we are going to check through NPV method whether buying a property is more economical or leasing a property is more economical. Now, before going into more economical, you should have a little bit idea about what happens in a lease. See, like what happens, this is a commercial area. In this area, there is a commercial property beside the roadside, beside the road. Okay, just give me a second. Just give me a second. Yeah. So there is this commercial property, which is, there is a commercial property. This is a main road of a particular, a main road of a particular street or an area. If there is a main road and there are many commercial establishments, if you pick any one of the commercial complex, okay, to buy, okay, you look to buy that complex. Let's say they will quote you 4 crores to 5 crores. Okay, it depends upon a property, bigger property. So generally you see many of the top companies which are Tata Chroma or Reliance Digital or Bajaj Electronics. All these people, what they do, basically they don't go for purchase, they go for lease. Why? Because purchasing that property, okay, or commercial establishment is very costly. If they put this much money, then they have to maintain a inventory, or they have to set up a inventory of 1 to 2 crores or 2 3 crores in that property. It completely costs them 8 to 10 crore to set up things. It is very, very costly. And if they want to buy also, they take loan for commercial properties. It is 40% you have to make the payment, 60% you can get the loan. So let's say 5 crores. So 22 crores they have to make the down payment, 3 crores they can get a loan. And if that particular business does not work well, then what happens? This property becomes a very costly investment. Yeah, you can give it for rental income, but everyone in the world doesn't want to enjoy rental income. There are companies which are working with some mission, vision, and they have some motive. Am I right? See, we as middle class, what we think is, let's give the property on rental basis. We can get good rent. See, that is being more, conservative and more, you look for more security, but companies don't work with that motive. Yes. So buying is very costly at times. Leasing, see, you have to just make a monthly payment or yearly annual payments, and you can use the property for 10 or 5 or 10 years, how much ever time you want, for that particular purpose which you agreed in the agreement. And it is a agreement between two parties, lessor and lessee. These are the two parties which enter into lease agreement. Okay. And they and this lease agreement allows the lessee to use the property. That means that it becomes right of use asset for him. So it allows the lessee to use the property for his business use. And just a second. So it gives right of usage of asset to lessee. Lessee can use the asset for a good amount of time and just make a monthly payment. It is somewhat costlier than making a EMI payment when you purchase a property to a bank. But let's say if the EMI is 40,000, lease can be 60,000 per month. But you are not making a down payment also, and it gives you a good amount of cushion to maintain very good inventory and invest. Let's say you save yourself from 2 crore upfront down payment. This you can use for, out of this 50 lakhs to 1 crore you can use for inventory, and 25 lakhs for renovation, etc. 75 lakhs you still have in your hands. That makes sense. Okay. So but that is not all we are looking at. We are looking at lease versus buy. We are going for a lease versus buy decision. What is happening in this case is, whether leasing is costlier or buying is costlier, whichever is costlier will dump it, or which of these two options are more beneficiary for us, higher NPV they are giving, we'll opt for that. Okay. So any of the cases, benefit should be high. Let's say lease gives more benefit than buying, I'll go for lease. Or lease is less costly than buying, I'll go for lease. Okay. Now we can understand that with the help of a question. Please read this. So simple lease versus buy. Brown company has decided to invest in a new machine which has a 10-year life and no residual value. So what is happening? Brown company has decided to invest in a new machine which has a 10-year life and no residual value, no scrap value. So they want to buy a new machine which is having 10-year life and also no scrap. That means zero scrap value. Now, purchased now for 50,000 with a bank loan. They have two options. Either they can purchase the property by taking a bank loan of $50,000, or they can lease the property for 10 years by making a lease rental of $8,000 per annum. And that too, this 8,000 they will pay every year at the end of the year. Now, what is the cost of capital? 9%. That means whenever you take a property on lease, okay, or you purchase a asset, doesn't matter. This is the required rate of return being an investor, and taxation should be ignored. So what we'll do first, today, if you buy the asset, you are making upfront payment of $50,000. What we'll do is we'll find out the present value of future lease payments. Why are we doing this? To check how much is the present value of all those future lease payments. If the present value of future lease payments is less than buying the asset, we'll go for that. Okay. That means leasing option will be economical and purchasing or buying will be costlier. So how to do that? First, we know that the future payments are 8,000 and it is for 10 years. We are going to make fixed lease payments. What are we going to do? We are going to make fixed lease payments for 10 years. Okay, the lease rental what we are paying is 8,000 every year for all the 10 years. So whenever we see fixed payments, we take annuity. So annuity factor at the rate of 9%, which is your required rate of return in today's market. Every investor has some kind of expectation, right? So annuity factor at 9% for 10 years. So it is 6.418. You can see the table, annuity table. Backside of your book, you have to just see annuity table. You will see years, that is 10 years, 1, 2, 3, 4, like that, 10 years and 9%. So this is 10th year. In 10th year, in this column, horizontal and vertical, there will be a value 6.418. So we take that into 8,000. So the present value came to 51,344. So if you lease the property, you have to, today it is costing you this much. If you lease the asset, it is costing you this much today. If you buy the asset, you are paying $50,000. Which one is less? Of course, 50,000. So I will go for buying option. Finished. So please see this question entirely. We'll move forward fast. Okay, let's move forward. We will do this question. Please read this. So, a company has decided to undertake an investment project which involves acquisition of a machine which costs $10,000. So, there is a company which wants to, you know, take an investment project, and under that, what investment they want to do is they want to start manufacturing it. Since for that, they want to buy a machine which is costing them $10,000, and machine has a 5-year life. It has no scrap value, 20% straight line written down allowances are available. That means this particular machine, whatever you're going to buy, it is going to depreciate by 20%, and you are getting you can tax allowable depreciation you can claim here. Okay. Second point, it could finance the acquisition. That means this $10,000 worth of machine they are looking to buy. For that, they can take a bank loan at 7.143% pre-tax and then purchase the asset outright, or make 5 equal lease payments of $2,500 in arrears. In arrears is nothing but first year, second year, third year, like that. In arrears, 5 payments they are going to do. That is for sure. 5 payments. Okay. Tax is 30% payable in the same year in which profits are made. Okay. So one thing I would like to tell you, lease, whatever lease, you are taking the property on lease, right? They're asking you lease versus buy. What are they asking you? Lease versus buy decision. Okay. So first we will take here leasing part. Here we will take buy. See, first of all, lease payments, they are doing from 1 to 5 years. What is the payment they are making? 2,500. It's I'm putting it in bracket. If I can put minus 2,500. Anything is okay. See, if I take in bracket, it's negative value. Whenever you make payments, it is negative value. It's cash outflow. Okay. Now, lease expenses also you can claim as deduction. You get tax savings on that. So what is the tax rate? 30%. 2,500 into 30% is how much? Please calculate. 750. So tax benefit. See, tax benefits are on two types of expenses. One is lease, one is depreciation. In both of them, you can claim deduction. Okay. The government allows. Or saved. Tax benefit or saved. 2,500 into 30%, 750. This is a benefit. You get, these are the expenses for 5 years, benefits for 5 years. Okay. So if you do netting on this, total. So 2,500 minus, so 1,750. This 1,750 is the net payment. Okay. In case of leasing. What is the 7.513, right? 7.143. Okay. So 7.143, it could finance the acquisition with a bank loan at this and purchase the asset outright or make 5 lease payments. So they haven't given any kind of implicit rate on lease. Okay. What is this is the pre-tax cost of debt. So we will take post-tax cost of debt. 1 minus 0.30. Because that is, we want the effective rate. Tax, however, we have to pay. 7.143 into 0.70. It becomes 5%. Okay. So what we are going to do is we are going to take this 5% because no other rate is given. We'll assume this is the rate for lease also. Discount factor at the rate of 5%. That means discount means annuity factor, fixed payments, right? So it is 4.329. You can check it. Multiply this to minus 7576. So this is your NPV because there is no investment you're doing. You're just making lease payments and this is your NPV. Okay. Buying option. What happens in case of buying option? You have to make a payment of almost 10,000. Tax allowable depreciation benefit. So for that, we need to find out the depreciation. What is the depreciation? 10,000 divided by 5 or 20% straight line. So 20% of 10,000 is how much? 2,000. What is the tax rate? 30%. See, depreciation is equal to 10,000 into 20%, 2,000. And then depreciation into tax rate, 30%, 600. This is the tax allowable depreciation. That means savings on depreciation, tax savings on depreciation. 600. We will keep it like this actually. 1 to 5 years. This is the investment happens in the zero period. Discount factor 5%. That means annuity factor 4.329. Multiply 6,000 into 600 into 4.329. 2597. So this is the inflow. What is the outflow? 10,000. 2597. It's costing you 7,403 upfront to buy the asset. See, leasing is costing you 7,576 and buying is costing you 7,403. Which is better? Buying. So I'll go for buying. Buying. So buying is better than leasing here. So I'll definitely pick my option as buying. Okay. Please have a look through this. We'll move forward fast. Read the question once again. Now, let's move forward and take the next topic. See, don't worry. Whatever the theory we are not discussing right now, we will discuss in one fine class and completely close this. Today, I want to explain all the methods to you. Okay. I want to finish the practical topics. Just give me a second. Yeah. So we are going to the next topic now. Capital rationing. What do you mean by capital rationing? You have limited capital. It's like you have taken 500 rupees to buy clothes, but what is happening? Since you have limited money, there are 5 shirts available. You like all of them, but you can only buy one shirt because you have limited money, or you have money as limiting factor. Okay, then what will happen? Of course, you will buy one shirt, but you'll pick the best one out of all the 5. So what happens in case of capital rationing? If there are two projects A and B, mutually exclusive, they become mutually exclusive for you. Why? Because you have limited money, you can't put the money into both the projects. Okay, if at all you put also, you can put some portion of money in this and some portion of money in this, that is divisible. And sometimes the projects may not be divisible, you have to take only one, mutually exclusive. So money, when you have in limitation, you have to choose the best out of all the rest ones, okay, or out of the rest. So in this case, what we are going to do is how this capital rationing happens. Why money is limited? There can be few reasons for that. Hard capital rationing, soft capital rationing. Hard capital rationing, this is where firm cannot get finance from capital markets. That means people are not willing to give money to company. Investors are unwilling to do that. Why they are why investors do not want to give capital to company? Very simple. Investors are unwilling or unable to invest more equity finance, or lending institutions consider the organization to be too risky. That means market is having recession. Right now you see commodity market is going very well. Of course, today there was a fall in gold and silver prices, but in fact, even though that is happening, FOMO, fear of missing out, many people are going to buy silver and gold again because they don't want to miss this rally. Capital markets are depressed and reluctant to lend. That means the markets are not in good shape right now, or no one wants to put money into a new business. They don't trust. These are all the factors due to which you don't get the required capital. And soft capital rationing, management themselves doesn't want to take more money. They want to restrict things. Let's say you have 10,000 rupees. Sometimes you are very very choosy in spending this 10,000. You have 10,000, but you want to restrict your spending to only 4,000, and 6,000 you want to save. Sometimes we do that. We don't overly spend. Yes, same way the management also thinks. So management may be reluctant to issue additional share capital because of a concern that this may lead to outsiders gaining control of the business, or due to dilutive impact on earnings per share. So they don't want to issue additional shares. Why? Because they think that outsiders may gain control if they buy bulk shares, or more shares can lead to dilution of EPS. That means there were 10 shareholders and $100 have to be given to 10 shareholders. So each one is getting $10. But the same $100, if have to be apportioned amongst 20 shareholders, each one will get how much? $5. So they don't want this to happen. They want good earnings in their hands. Management don't want to raise additional debt capital because they fear, okay, they don't want to pay more interest, and that they fear that that may reduce the profits. Creating competition for limited pool of funds encourages divisions to search for very best possible projects. So they don't want to give more cushion to the departments, or the divisions. They want them to use the funds in the best possible manner, and that can create good competition among all the divisions, to come out with some innovative ideas or some ideas where they can save a lot of money. So this is what they purposefully do. Now, capital rationing in case of two things: if the projects are divisible, that means you divide your money into two projects, or when the projects are not divisible, that means you don't divide your money, you take one project and that's it. Okay. So whenever the projects you take which are divisible projects, if projects are divisible, work out the present value of cash inflows per dollar invested. That is, you have to rank as per profitability index. So for divisible projects, rank as per PI, profitability index. For non-divisible projects, rank as per NPV. Okay. So this is what you have to do. Now let's take a question. What is the formula for PI, profitability index? Present value of cash inflows divided by outflow. So let's say the present value of all the cash inflows is 1,10,000. Your outflow is 1 lakh. So you got 1.1. That means 10% more than what you invested, you have got the cash flows. So any project whose PI is more than 1, that means more than 100%. Whatever you invested, you got more than that, right? 1.1 is more than 1. You can take that project. Okay, accept it. If it is 1.2, even more better. Please read this question. So we will just discuss. Suppose the hard times company is considering 4 projects, W, X, Y, Z. Hard times. See the name they have taken as hard times. They don't have